Wow, we just had an amazing inflation reading for June. The June CPI month over month actually showed a decline in prices for its first negative monthly print since 2020. Month over month showed a decline of 0.1% compared to the 0.1% estimated. And then for headline, year over year came in at 3% compared to the 3.1% estimated. And then core CPI, which is minus volatile food and energy, came in at 3.3% compared to 3.4% estimated. And then core CPI month over month came in at 0.1% compared to 0.2% estimated. What's even better is that super core inflation and shelter inflation is actually showing signs of cooling. Shelter inflation is the coolest since 2021. So this is a Goldilocks report, in my opinion. And this combined with the unemployment rate ticking up is something that the Federal Reserve will want to see. And this is boosting chances of a Federal Reserve rate cut in September to at over 80%. It seems very likely that we're going to have those two rate cuts in the market. Jerome Powell had testimony on Tuesday and Wednesday pretty much saying that the risks for inflation and employment are more in balance right now, and he's watching the cooling labor market. And he said that there's risks of cutting interest rates too late and too little in terms of weakening the economy. So him and the Federal Reserve are starting to watch that now. I think that's good news for risk on assets like growth stocks, tech and small caps, industrials, financials, and some of the FANG stocks that have been laggards. We saw Tesla. Tesla was up 11 days in a row yesterday, and it looks like after this CPI inflation report, Tesla could most likely have its 12th straight day of gains, up over 40% in just 7 days alone. Not only did Tesla beat its delivery estimates, but looking at its report, its solar energy deployments were actually double than the first quarter. So this is very, very good for Tesla stock, in my opinion, and that's also a sign of risk-on sentiment in the markets. Tesla, I view it as not just a car company, but a energy storage, robotics, and most undervalued artificial intelligence play in the market, in my opinion. So that's good news. And Ed Yardeni just put out a note that he's upping his S&P 500 price target from 5,400 to 5,800 by end of the year. And his decade target by the end of the decade for the S&P 500 is 8,000. You know what? I respect Ed Yardeni very much. And Tom Lee also has a 5,800 year-end price target for the S&P 500. I said I wasn't going to revise my S&P 500 price target up from 5,600, but seeing that we saw a negative CPI month-over-month print, that'll likely help risk-on sentiment in small-cap stocks and mid-cap stocks that have been laggards. And you know what? I'm going to up my S&P 500 price target too to that 5,800 level. Because of that, obviously we have some risks with the election and if the Federal Reserve will actually have that September rate cut, and there could be risks of inflation reaccelerating, but hopefully that's not the case. Once you have a negative print for CPI, it usually tends to cascade in that direction. So that's good news. And look, bears have been left behind in this party. Mike Wilson's no longer chief investment strategist. I think he still works at Morgan Stanley, but he said that the market would decline very substantially over the past 2 years. And although he was right in 2022, he was wrong in 23 and 24. Right now, he put out a note that he wouldn't be surprised if he sees a 10% correction in stocks. That could be possible, but he was also wrong in 23 and 24. So obviously we have to take that with a grain of salt. And Wall Street's also saying goodbye to another one of its biggest bears, J.P. Morgan's Marko Kolanovic. He was bullish in 2022, which I think was a good thing because the market was doing bad. And then close to the bottom, he was pretty bullish. So I think that was an appropriate time to be bullish. But then he flipped to being bearish in 23 and 24 when the market hit bottom in October of 22 and did very well in 23, 24. So he was left behind in this rally. So in the long run, it always pays to be bullish in the long run. Obviously, we could always be prone for a little bit of a pullback, but that goes to show you if you don't change your opinion, you could be left behind. And as I said, I still think the S&P 500 should do very well by the end of the year, stocks in general, and I think 5,800 could be in the cards.